Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hey, welcome back. This is Todd Taskey, the host of the Second Bite Podcast, where we get a wonderful opportunity to talk with entrepreneurs and CEOs about building valuable companies and eventually exiting those businesses. And I think I've determined people really love this podcast because we talk to CEOs that I'm going to describe as unknown CEOs. They've built 7- and 8-figure businesses that they've transacted, and in most cases, got a bunch of cash when they closed and are working on a second exit or a second bite of the apple. And we get into a lot of detail that I think is helpful. Today, we don't have a CEO of a business, but we have a trusted advisor that I've used on many cases that we have brought back, Don Keninitz. Don, thanks for being with us again.
Happy to be here.
Hey, and so Don, I had you on because I thought it would be helpful once before in what we're now calling part one. And it was so valuable specifically because and for anybody listening, you got to go back to part one of my interview with Don, because there was probably 3 or 4 or 5 ideas in there, specific ideas that actually will impact your EBITDA in the current year that you may not be aware of. So I would encourage you to go back. And there was so much that we needed to have a part 2, Don. So I'm glad we're doing that. Before we jump in, I do want to shout out and thank our sponsors at Cohen. So Cohen, where Don happens to be employed, is a full-service CPA firm in Rockville, Maryland. They offer a full suite of tax, but also consulting services. They do a wonderful job of preparing financials so that clients like the type I represent look the very best they can when they're in front of in front of buyers or investors. The people at Forbes magazine say they're one of the most recommended accounting firms in America, and are almost annually on the list of best places to work. So if you want to check out Cohen, you can find him at ecohen.com. And we are also fans. I had Kevin Oregon on a podcast a couple episodes ago, Don, who you were very helpful with their combination and acquisition. So lots of folks that are fans of yours and Cohen. So with that said, Don, welcome back. I want to pick up where we left off last time. And as I remember, we left off the last episode. We were talking about things that are on the P&L that guys tend to overlook. And we had talked about deferred revenue, and then I had a list of other things: working capital, right, accrual versus cash, vacation time, other things that kind of bite you in the ass if you're not paying attention. Why don't we start in kind of from big picture down to granular? Talk just a little bit about the difference between accrual and cash. And if I'm cash-based, most people listening are going to be cash-based taxpayers. Just talk a little bit about the difference and what that means and how it impacts financials, please.
Sure. So let me start by saying that there are a lot of really, really small businesses. And the cliche I like to use for this, I use the mom and pop corner liquor store, which we don't have in Montgomery County, but you do in D.C., Virginia, and all places, kinds of other places. These are retail businesses where typically they're going to maintain their books, what we call the cash base. They recognize their revenue when they collect cash, and they recognize their expenses when they pay bills. And that's considered a very unsophisticated method of accounting, but it's expedient, for a really, really small business. Also, but more importantly, and probably more to the point with the types of clients that you and I work with, Todd, is that the cash basis of accounting can infer or can confer a tax advantage to businesses that use it for tax purposes. All right, because if you're a service business in particular, and so long as you don't do revenue in excess of a certain amount, you use the cash method, and obviously that's advantageous from a tax standpoint, or should be, because you don't recognize income until you actually collect it, but you recognize the expenses for the most part when you pay them. And that gives you a couple of advantages. One is you can kind of manage your income a little bit with that. And second, you don't have to recognize income or revenue before you've actually received it.
So let me just drill into that for a second, Don, because, and I'll use a simple analogy so we're all on the same. You referenced a liquor store before. If somebody comes in and pays $100 for a box of liquor, that's revenue because you've sold that transaction's over. But if somebody hired you, let's just say, to build a website, and you can build that website in a month and it costs $10,000 to build the website. When you get the check, the day you got the check, it's not earned revenue because you haven't done any of the work yet. Correct?
Correct.
And that's a big difference, particularly as we talked about last time, as it gets into longer contracts, as it gets into recurring revenue monthly contracts. So maybe you could kind of pick up your example from there.
Well, true. That's true. We talked about that yesterday in the deferred revenue section. But the opposite kind of transaction is probably more common. I.e., we do the work for our customers and then we send them a bill.
Right.
And if we're lucky, they promptly, and if we're not so lucky, they pay it not so promptly. And so the advantage of being on the cash basis is that we don't have to recognize that revenue until they actually pay our bill. Now, in the meantime, our suppliers and employees are not standing still, and they're making us pay them timely. And so typically what happens is a company on the cash basis will often be able to minimize their income or even actually report losses as long as they're growing. The reason I say that is because your accounts receivable are going up over time, which means your collections are lagging. Right? And that's just normal for business in a growth phase. So the cash basis, in fact, every client that can be on the cash basis for tax should be on the cash basis for tax. I'm going to put that out there right now, with the exception of a company that's no longer growing or is flat. You lose the advantage when that happens. Now, small CPA firms, and here I'm talking about 1- and 2-man shops, they tend to be unsophisticated. I'm not trying to knock my peers here. They are what they are. You don't go to a general practitioner doctor if you need triple bypass surgery, and the same is it should be true of businesses. So those tax preparers, sometimes some of whom are not CPAs, by the way, will tend to take the path of least resistance, and they'll say, okay, I'm just going to do on the cash basis, not because it's tax advantageous, but because it's easier. I don't have to do anything except, keep your books on the cash basis and go that route. That is considered absolutely, rudimentary and crude for financial reporting purposes. No bank would accept a set of financial statements on the cash basis. No buyer is going to give you any credibility if they see financial statements on the tax basis.
And to that point, Don, if you submit financials to a potential buyer and they're on a cash basis, not only will somebody not accept them, in many cases, they may just throw their hands up and say, this is just going to be too long of a road to educate these guys to get to close.
Absolutely. We have many clients who are on the cash basis for tax, but let me tell you the way that works. They keep their book on the accrual basis, or in some cases, but we do have an accounting outsourcing department that maintains books for certain clients that want that service. We maintain them on the accrual basis. When we go to file their taxes, we do what's called a simple accrual to cash conversion. It's, like falling off a log if you know what you're doing. And so that way the books are always kept on the accrual basis. And then the direction of adjustment is to convert the cash just for tax. What you don't want to have is cash basis books that you then have to convert to accrual for anybody that needs accrual basis financial statements, be it a lender or a prospective buyer.
Right.
And just as you said, they're going to throw their hands up, and the same is true of a bank. They're going to go, and there's a lot of work to get it converted back to accrual properly. And
Yeah, so let's end on that because there's a lot of good things I want to get to. But I would say this, the things that you just iterated, I think anybody listening should have that conversation with their CPA. And I think that's a reasonable test to see if you've begun to outgrow your current accounting shop or your CPA in terms of how they answer those questions between cash and accrual. Let's go back to the balance sheet for a second. We talked last about deferred revenue. We talked about how you might be able to adjust your rent based on any discounts you got up front to reduce expenses, those kind of things.
Right.
I want to get into working capital for a second, but I want to spend just a minute because it's something that impacts the P&L when it comes time for a transaction, and that's the notion of add backs. And so,
Correct.
So the general concept here is a pretty simple one, which is any buyer, they understand, particularly for companies, let's call it between 5 million and 20 million or 25 million of revenue, that they're using the company in an appropriate and legal manner to minimize, tax obligations that they have to pay. The company, the buyer, essentially saying, just tell me what I get. Just tell me what's really going on and make these adjustments. So a lot of the most common ones that I see are company cars for the owners, right? That'll stop after close, but we want to get that added back because that'll improve your EBITDA. Life insurance payments, things like that are country club dues, all of those type of things. I want to throw in a couple others and get your input on others still. Anything that's a one-time expense that's unusual. For example, we've had clients in the past where they signed a new lease and they were able to put their sign on the building, and that cost 30 grand or 50 grand or what have you. It's just a one-time expense. We added that back. The expense to move the office is a one-time expense. We've had that added back. There are other items that perhaps are a little bit more aggressive, but we've had good success with. For example, a transaction we closed at the end of last year, my client in the year prior hired a hired a COO. The COO lasted about 9 months, turned out to be not a position that they should fill, and they hired the wrong person. So we added that entire expense back under the premise that we tried something, it's a mistake, it's not going to be an ongoing expense, and it's not needed in our business. So, right. And the way your facial expression is, buyers sometimes will wonder about that, but depending on the overall presentation, we at least start at a better number from an EBITDA perspective. Are there other things that you see companies are able to successfully negotiate as an add back? And are there anything that you see that guys try to add back that's always problematic and never really works?
Yeah, let me start by saying that I like to think of these in terms of 3 buckets, okay? The add backs that we're talking about. The first one that comes to mind is what I'll call discretionary expenses. So companies can undertake discretionary expenses that a buyer would not undertake. A common one is charitable contribution. All right, you might have the corporation donate $25,000 to a charity. Now, sometimes these are marketing connected. You do it for the sake of you got a couple customers would like to see it happen, whatever. But whatever the reason, I would call that a discretionary.
That's a good one.
Expenditure. So, and there are other types of discretionary expenditures, and we want to identify those. We want the client's help in identifying those, so that you and I can bring our judgment to whether or not we want to add them back. All right, whether we think there's a good case, and we both like to be aggressive on that, but we'd like to be upfront. The discretionary expenditures, and so we need the client's help in identifying those. The next is, and we have to be candid about this, clients in that size range are apt to try to include what some people might call personal expenses. And by that, I'm not talking about something illegal. You're paying your housekeeper or something like that. But you gave a couple examples already: personal automobiles, country club dues. Oh, hey, those can be a marketing benefit. You take clients out, you play golf with them, sports boxes and things like that. But you start from the premise that the buyer's going to say, well, those aren't necessary, so long as you can persuade them. Well, yeah, I take people out, all that, but I don't know how much business.
Right, it's mostly for entertainment.
Right. So I'm calling those personal expenses. Obviously, officers' life insurance policies. We even had a case where somebody had a chauffeur. Okay, and the buyer is going to say, I won't be using.
Right. As an example, just to iterate that, my client had a driver that he used occasionally, paid him $60,000 a year as a legitimate expense to the business, and that was going to stop post close. The driver happened to be his father-in-law, which was a good gig for his father-in-law. But again, it was
what we're talking about. Yeah,
he was paying his father-in-law $60,000, and that business, if you remember, Don, sold for 8 times EBITDA. So 8 times 60,000 is almost $500,000. He was happy to share $60,000 a year with his father-in-law. He didn't want to have it cost him $500,000. And we had no problem getting that approved by the buyer. So personal expenses is the first bucket. What's the second?
Well, so we had discretionary first, then we had personal. And before I go to the third one, I do want to say, let's emphasize that point you just made, Todd, because I don't think, we both come across clients that don't want to put in the effort to describe to help us identify these because they don't understand the multiple concept. If you think the business can get a multiple of 8 and you can find buyers that will pay a multiple of 8, well, a $25,000 add back is $200,000 more for the seller, and they need to understand it. I can't emphasize that strong enough. We're dealing with one right now who is willing to throw a bunch of stuff off the balance sheet just for the sake of expedience, and I'm thinking to myself, you're throwing money away when you do this. Okay, all right. The third category you touched on already briefly, and that is just non-recurring expenses. Okay. But I would add to that misclassified expenses. So non-recurring, Todd, you gave some great examples already. You incur costs to move. You're not going to incur those costs to get it for 5 years, and the next time it happens, it'll be on the buyer's time because he or she will have grown the company to the point where it needs more space, and that obviously then they should expect to pay for it. There's some other ones, and I'm going to give you one right here that we both know about. Okay, so you might, if you're a company that's developed some kind of a proprietary technology or business process, or if you're into digital marketing, some kind of search engine or whatever thing, and we had a client that spent probably $500,000 on that, and they expensed it. And the expense had happened, I think, a couple of years earlier, and it depressed their earnings for that year. Well, in some cases, you can capitalize that, put it on your balance sheet as an asset rather than reporting it as an expense. All right.
So, Don, let's just pause for a second. So I'm going to make up some numbers, but a client has a net profit of $3 million. And they don't want to pay tax on all that. So they look around and they say, shit, we spent $500,000 developing this technology. You know what? Just take it as a deduction, book it as an expense. And now my profit is down to $2.5 million.
Right.
Right. So that helped them on their taxes in that year. Talk about the impact to EBITDA in future years and what that means if we put it on the balance sheet.
Let's say it's the current year and you develop something where we could make the case that it should have been, if we could not capitalize on our GAAP, and we talked about GAAP yesterday, generally accepted accounting principles, we could at least argue that it in fact really is an asset to the buyer going forward, even though we paid for it out of pocket. All right. And we want to, if that's $200,000, that's $1 million on a multiple of 5, but we often get multiples well in excess of that. And I know it was a particular home run for this one client when we identified this. And this actually harkens back. This is why you don't want your when you know you shouldn't be changing CPAs is because the 1 and 2 man, the local guy that you get to do your book, it was, he's going to be probably perfectly adequate of that up to the point. He's not trained to recognize this kind of stuff. These are more sophisticated GAAP issues and or just more sophisticated accounting issues that are just not going to occur to that person.
Right.
And I look for this kind of stuff.
Right.
I'm trying to be an advocate for my client, but at the same time, because of my experience in business on the buyer side, I also will tell the client what not to do. So, one other one and I'll put it in the discretionary category, which is we talked about this briefly yesterday, so I won't spend a lot of time on it and let you take it as far as you want. But sometimes we have companies where they overpay management, and we can take a portion of that and say, hey, on a going forward basis, the buyer won't have to pay $450,000 a year to the CFO, who may have been one of the family partners. He can get by with a great CFO for $200 or $250, or maybe even less, depends on the business. So we'll take that as an add back. However, on the other hand, we also get cases where somebody's paid themselves a $75,000 salary to run the company, but they're taking the rest of the money that they are entitled to. They're taking it out in distribution, okay, as an S corp or an LLC. Well, we know that a buyer is going to say, well, I can't run this company. I can't get someone to run this company at $75. And it's better to be proactive, as you and I have talked about many times. We want to present the number.
Right.
If 75 is not the number, we want to present the number that we think they should be able to. Let's say it's 150, rather than when you get a negotiation, because they know how to negotiate well, they go, it's going to cost me at least $250,000 to get somebody to run this.
So let's talk about when somebody buys a company, they expect that there's going to be somebody to run the company. And there's an expense to that position. Let's call it the CEO, for example. So let's take a business that's making $2 million of EBITDA. And let's say the CEO is paying himself $300,000 a year. They make $2 million of EBITDA. They take the distributions. Doesn't matter if it's salary or distributions. There's some impact on taxable income and the rest, but let's just say that's the case. Once we explain the concept of add backs and how much they can benefit from those add backs multiplied by 6 or 7 or 8 or whatever the number is, then the most common response I get is, well, shit, put my salary down at $100,000, right? Because then instead of 300 a salary, I'll be at 100 a salary. I'll add 200 grand more to EBITDA times 7. That's 1.4 million. That's a great deal. The buyer is going to look at that and say, if the CEO leaves, I can't put somebody in this. I can't hire the right person for 100 grand, right?
Right.
So we want to dial that number in, something in this example below 300,000, but something that's believable, right? So if it's 200 grand, is that believable? Probably. Is it 225? But there's some number, 50 or 75 grand lower, that we can again add to add back. And to your point, Don, we want to show the EBITDA number in a full set of financials. So when they ask, what do you have for CEO compensation? We say 200, 225, and they're like, okay, well, that's about right. As opposed to arguing whether it should be 100 or 150 or 175,000. So
we want to control that process.
We
by
absolutely
being proactive.
So let
the perspective higher.
Yeah, so those are great. So the buckets, discretionary, personal, and non-recurring, super helpful. Let me move on to something that is.
Well, before you do, I just want to a good way to summarize everything that we've been talking about in terms of if we're putting our best foot forward is, I've known Todd for a while, and I can assure you that when he leaves the house, his wife does not inspect him for any fashion faux pas. So he goes out with his best foot forward. I, on the other hand, who thought I was a fairly snazzy dress for my time, my wife gives me the complete once over, and then I'm permitted to leave the house after that. So that's what you and I do. Okay, we make sure that the wife is check those books to make sure they're going to be as advantageous to our client as
So
they
we're not going to
possibly
move back.
can. No fashion faux pas. Yeah.
Very good analogy, Don. One thing that's always confusing at the level that we often work is the concept of working capital. Because there's a couple things in there. There's a very simple definition, right? Working capital are current assets minus current liabilities. You can find current assets and current liabilities right on your balance sheet. But the concept is this. This is the way I use the analogy, and I'd love to hear yours, Don, because it's probably better. But if you sell an automobile to a guy out of Craigslist or I was going to say the paper, but I'm not going to date myself. So you sell it to a guy out of Craigslist, and he comes over and he buys a car and it's $10,000. He assumes he can drive the car out of your driveway. He assumes that there's gas in the tank, right? Now, we can argue over how much gas should be in the tank, right? And an experienced automobile buyer might say, okay, I'll pay you 10 grand, but there better be a full tank of gas in it, right? A lot of times people don't even think about that. And mostly they don't think about that because to fill up a tank of gas is $50. Who cares, right? But when a buyer makes an offer to acquire a company, they assume that they're not going to have to put more money into it in month one and month two to meet the regular expenses of the business. So that's how I would describe it. And then the question then becomes, all right, well, how much gas in the tank, how much cash or current assets in the company is the right amount? I, as a rule of thumb, always try to guide my clients to somewhere between 1 and 1.5 times your monthly expenses as a general price, right? Oversimplified, because there's a lot of factors that will impact that. But that's how I describe working capital and try to give guys an idea for what that will look like. You do this, for 30, 40 years, and you do it more often than I do. How would you describe it?
Okay, I love your gas in the tank analogy for starters. Okay, I recently bought a new car, and new car dealers now actually deliver a full tank. Okay, they do. All right, and so I think that's a great analogy. But now let's and then I'm going to second your view, what I'm going to call a practical view of how to think of working capital, and that's probably going to relate well to business owners. In other words, how much of what we call working capital do you have to have on hand to effectively run the business? Because the buyer is going to sit there and say, well, I'm not going to pay X million dollars for the company and then come in and find, let's go back to your auto example. I'm going to pay $10,000 for the car, and then I'm going to drive it off the lot and look at the gas gauge and realize I now got to go put $50. Let's say it's an SUV or a truck, and it uses premium. I'm going to go have to put $60 into the tank immediately to get home, and that's $10,000, $60 I just paid for this thing. Now that $60 is minuscule compared to $10,000. In a business world, the relationship between the numbers is much more significant. But since you gave the practical example, let me muddy the waters here a little bit, just because I want people to understand how sophisticated buyers look at it. They are going to be a little bit less apt to just look at that practical aspect, because look, hey, well, Tom, we should explain the way these deals work is a working capital target is negotiated, and then when the deal closes, the buyer takes possession of the books, calculates what the actual working capital is as of the date of purchase, and then typically, if it's more than the target, the seller gets a dollar for dollar increase. If it's less, the debt seller is going to have to pay back a dollar for dollar. And now the buyer has control of the books, and the buyer is driving the bus at that point as to what the real working capital is. So I want to make that clear. When Todd, and then also just to expand, when Todd said it's current assets, current liabilities, let me explain what those are. A current asset is anything that is either cash or expected to be converted into the equivalent of cash within 12 months of the balance sheet date. So accounts receivable are normally an element of working capital because you expect to collect them and convert them to cash. Prepaid expenses are typically an element of working capital because you expect them within 1 year to be they represent something that's been already paid for but will be consumed within a year. So it's just if you're paying the cash as you went. Those are probably and inventory if you ever have that. Those are the three current assets, or four current assets you get there. Then the current liability side, you exclude current debt because most deals are debt free. In other words, you as the buyer, the seller.
Right.
So we're looking at things like accounts payable, accrued payroll, accrued leave vacation that we talked about yesterday.
We don't need to go back into the granular there, but for somebody to listen to episode 2 first, you got to go back and listen to episode 1 because those are things on your balance sheet you got to understand well.
Right. So now the accounting definition, working capital is simply the difference between those two. I prefer to look at it as setting from a target setting standpoint as a ratio. For service-based companies, I will typically say, look, a buyer is going to expect the current assets to be about 1.5 times the current liability. All right. Once you have that ratio in mind, you can take any company and convert it to a dollar amount. So if you have a company that has $1 million in current liabilities, then a buyer is going to want to see $1.5 million of current assets. And then that means the difference between those two is $500,000. There's your target. All right. Now, as a seller, I want to help you identify all of those things in advance. Todd can't negotiate a good working capital target where down the road, a buyer's not going to suffer when the seller discovers unrecorded current liabilities or misrecorded current assets. I want to help you discover those early. So, for example, a lot of smaller companies will have prepaid expenses, but because it bothers them to account for them, their account may just be expensing the stuff as he goes. You pay for the insurance policy a year early, he just writes it off as an expense instead of putting it as a prepaid expense.
Right. So, Don, hold your thought there. I just want to highlight how valuable and important this is. So we get a balance sheet, right? And I'm going to make up a couple numbers. The hypothetical company we're talking about does $9 million of revenue. They have $7 million of expenses. So their EBITDA, their net, is $2 million. Okay. And we're selling this business for 7 times. So it's $14 million. They're going to get 8 or 10 or whatever the number is cash at close. There also has to be an appropriate amount of working capital in the business. So in my example, on the balance sheet, there is cash and accounts receivable. Those come up to $1.5 million. And then there's current liabilities, which is perhaps payroll that you discussed. There's accounts payable. There's things of that nature. That's $500,000. So the difference between the $1.5 million current assets and $500,000 of current liabilities is $1 million. Okay. So that's what we have now. We have $1 million. And the question is, how much should be in the company for working capital? We know that there's $1 million. So to use a rough example, if you take the $7 million of expenses and you divide it by 12, that's $585,000. If we can negotiate a 1-month working capital target, that's $585,000. If it's 1.5 times, that's $850,000. The difference there is $250,000. That $250,000 will either wind up in your pocket or it'll wind up in their pocket. Now, to your point, Don, there's a couple of things. We win the negotiation on working capital way before it starts. We win this while we're negotiating the LOI, although guys are very hesitant to commit to it. And we win it because we've got the support of a strong accounting mind that can help me, right? So number one, if you've prepaid some of your expenses, right, because you're trying to get discounts from last year, you're trying to do any of those are additional current assets. All of that's going to wind up in your pocket, all of it. Okay?
Yeah.
Number two, we want to, for example, the two deals we talked about on episode 1, my guys have recurring monthly revenue. So the buyer knows they're going to have money. They're not going to wait, like you talked about, that they've done the work and now we're waiting to get it in 60 to 90 days. They know they're getting money literally every week right after post-close. So we're going to start to argue a lower working capital target during the LOI. And we're going to position that by saying, regardless of what it is, and the buyer says, we think we could pay 60% cash. I say, gosh, my guys will never go for 60% cash. And so we wind up at 70% or whatever the number is of cash to say, listen, the only way I think I could get my guys to agree to this number is that you've got to agree to a lower working capital target. Because the reality is, when that buyer tells his investors, his partners, or his board how much he paid for the company, they say we paid $14 million or 7 times or 5 times EBITDA, whatever it is. In the history of the world, there's never been a follow-up question that said, well, how much working capital did you negotiate with the business? It's never happened. So there's, to some degree, there's a pot there that we know we can grab. But if you wait post-LOI, in the last 2 weeks after you've spent 60 days of due diligence and you've negotiated a lot of your documents, they're just going to squeeze you because they're going to have all your finances. They're going to say, Jesus, man, we didn't realize you were this. And it's just such a harder conversation. That's how we are successful in negotiating this, because we focus on this on every deal. But to your point, having the data, having the understanding, the real understanding of a balance sheet, what's current, both assets and liabilities, the growth rate of the company, what the cash flow of the business is, all of that argues towards a lower working capital target in most cases.
Right. And here's another thing that we come across, Todd. I know you'll recognize instantly. So Todd's been giving a great practical way of looking at it, and the way it should be looked at for negotiating purposes. And this is, what we do when we're trying to negotiate right to target. The buyer is going to look at that balance sheet and see what does it say the working capital is, and assume, if it looks like it's really good, that's how much it takes to run the business. And here's where we see this come into play. We have some, conservative sellers who like to sit on a mound of cash. All right, they just feel safer having it in the business, and that creates the illusion. Well, it creates, first of all, the working cash calculation says, oh, there's $3 million of working capital in this business. It must take that much to run it. And the reason is because there's $2 million too much cash sitting in there because of a conservative seller. And we will, at times, Todd will say, you got to get that cash out of there. Distribute it to yourself now, or your buyer is going to capitalize and try to figure out a way to keep for, himself.
Well, and if nothing else, Don, either that you'll take the cash out, or number two, when I present financials, I will tell the prospective buyer, the only reason there's $3 million of cash in here is because my guy will only do distributions at the end of the year. My guy can't sleep unless there's $2 million of cash, whatever the case may be. But I'll tell him up front, do not hold this against us. You don't need this much money to run the business.
Right. So this is why it's important to know all of this stuff going in and be properly advised.
So and then what happens so that you know? So now let's say, for example, there's $1 million in cash in my example. We've negotiated, so the working capital target that has to be in there at close is $600,000. So there's $1 million in there. That's $400,000 extra.
Yeah.
We're going to close on Friday. If you want to take it out on Monday, go ahead. You want to take out all 400? Go ahead. You want to take out 500? Go ahead. What's going to happen when they do the calculation at close, they're going to say, hey, there's supposed to be $600,000 in here. there's only 500. We're not going to pay you 8 million cash. We're going to pay you 7.9. If you've left everything in there, they're going to say, hey, there's 400 grand extra in here. We'll pay out the extra. So now we're going to pay you the $7.4 million of cash, right? So it's meant to be arbitrary. It's meant to be neutral to whatever your behavior is post-close, right before close. And the other thing I would mention is we're going to close on Friday. And so we get there, but you've been operating the business, right? There's bills coming in, there's stuff going out, there's invoices that haven't come in, all this kind of stuff. There's going to be a true up, usually 60 days later, to say, here's the 600 grand we agreed was a working capital target. Here's what we thought was going to be in your accounts receivable. There was some stuff in accounts receivable that's really old, and we decided we're not counting that. Blah. So there's adjustments typically 60 days after a transaction, and all that stuff gets reviewed. But the working capital part is always tricky, and what I always find is for almost every day from signing the LOI to the deal close, you argue about working capital. We always try to get a target built into the LOI. Almost every time the buyer will say, we don't know enough about the company to commit to something like that. Sometimes we can get them to commit to a range. But we like to jump out ahead of that argument for exactly the reasons that we've talked about. So, Don, all of this stuff has been super helpful. I want to end with a last couple of things. You've worked on plenty of deals, vast majority of them successful, but not every deal gets to close and they blow up for a whole bunch of different reasons. Is there, in the smaller size, the 5 million to 30 million of revenue companies, is there a common theme for why deals fall apart that you see?
Yeah, a couple things. I will say that, since I do expert testimony work in M&A, and a lot of times it doesn't get to litigation, but when there are disputes, probably 75% of the time they're around working capital, the thing we just went over. The buyer takes substantive possession of the books and argues, hey, you didn't come close to meeting the word. We found all this stuff, they crawled out of the woodwork. And so that's what we want to make sure we've gone into the woodwork before they do. So that's one thing I want to.
And let me just underscore that. I tell us to clients all the time, there's too many people in the room, and all of them are smart to think that we're going to sneak something by. But to your point, 75% of litigation is around working capital. If you're trying to sneak something by, it's going to get found out. So let's save ourselves the heartache, right?
Right. The other things that happened are where the buyer will find some what they perceive to be undisclosed liabilities, things that maybe the owner's been keeping under their belt. There's maybe some litigation pending or something, or it wasn't pending, but the seller knew that there was somebody unhappy out there for one reason or another. And then the buyer comes in and discovers that. Sometimes that can be an impediment to getting the deal closed, or at least litigation down the road. Or in verbal conversations, there are, I will call them promises, but characterizations about customer relationships, the customer commitments, customer solidity, that the buyer, subsequently discovers, or feels that they've been misled. And what this brings me to, by the way, is, because I'm involved in a couple of these right now, is when you write the deal, you've got to have an eminent M&A attorney write the deal. You cannot use the guy that's been doing your collection for you.
Right. And by the way, just so the listeners know, that guy, that lawyer will tell you, of course I can do it. It's not that difficult. I think what you should look for is somebody that only does M&A, right? Just like you would only want to have a litigator if you go into court, or a bankruptcy lawyer if you're filing bankruptcy. Make sure you have a good M&A attorney.
Right. That lawyer is going to tell you, as you said, oh, yeah, I can do it all the time. Then he's going to head right for Google and try to find sample agreements. I have a thing right now where there was oddly enough, it goes back to working capital. It says working capital should be determined on the basis of GAAP, which means you identify the current asset as GAAP would, and the liabilities. And yet the buyer, or excuse me, the seller, I represent the buyer. I'm representing the buyer. The seller excluded some very significant liabilities from the working capital estimate. When I got involved, I said, hey, these are millions of dollars. They should have been in there. They owe you money back, not the other way around. And because their attorney, it is a big company, but they didn't. I think they just figured this was a small enough deal they could just go sloppy. He put that GAAP language in there with no qualifiers. This is the kind of thing is you and I are going to look at these things when they're written, and we're not going to let any holes be in.
And Don, it's a great example, and I'll take the other side of it. We literally just closed a deal on a week ago, and our client, all of their books were prepared GAAP on accrual, but they've been operating the business on a cash basis, and so for the earnout number, they want it done on an accrual basis. We said we'll do it on accrual, but for purposes of the earnout, the documents say that it's the business as it has operated in the past, and it's operated based on. And so my guy's got almost $2 million of earnout to collect, and if you do it based on GAAP on accrual, there'd just be no chance for him to earn that. That's one sentence. I think his documents were 85 pages. One sentence in there.
Yep.
So to your point about having a really good a really good M&A attorney, you got to think through all of this stuff, and it's reasons like that people complain that the earnout, that the back end, the second half of the deal they never get. It's usually because they don't have good documents and they don't have a good fit and things of that nature. And as I think, and I'll bring us to close here, Don, and this has been, again, very educational. Yep. I think, what this really illustrates is that there's 100 moving parts. There's a lot of little pieces, but every little piece could be a lot of money, right? And to have an experienced team, banker, lawyer, accountant, that work together to make sure that's how you maximize the value of a transaction. And if you have that confidence around your financials, you can create a back end that you'll collect on, you'll perform on, and will be treated fairly because of that. You'll get all the appropriate amount of working capital, just on and on and on. So with that, I must say, Don, I am surprised that the topic of accounting around M&A transactions spilled into a two-part series, because most people would consider it to be boring. Once you get into it and you realize how much money is on the table, you get a lot less bored and you pay a lot more attention. So again, I'll say thank you to you, Don. I enjoy all the time that we work together, but your knowledge that you shared on both these episodes has been great. So thanks for your participation.
Oh, I'm happy to participate. With a closing note, I would just say, because you said a team, I was just going to say that a good M&A attorney is not going to know what needs to be. Half of a deal is boilerplate, as you know. If the other half that is important, and they need to hear from you, me, people like us, and then they write that airtight document. It's
a real team approach. Agreed. Don, thanks again. You have a great rest of your day.
I will. It's Friday. I always have a good day on Friday.
Same here, Don. Thank you.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.